the renowned investor Jeremy Grantham. Grantham has been making headlines with his forecast that everything will collapse. What does he mean by this? And what evidence is he basing this prediction on? In this video, we'll explore Grantham's warning, the economic indicators he's watching, and what this could mean for your investments. Jeremy Grantham, a well-known investor and co-founder of the asset management firm GMO, has gained attention for his predictions about economic and market collapses. Grantham's views are deeply rooted in historical analysis, economic data, and his understanding of financial bubbles. Jeremy Grantham's prediction that everything will collapse, delving into his theories, historical context, and the potential implications of his warnings. Jeremy Grantham has built a reputation for identifying financial bubbles and predicting their bursts. He accurately foresaw the dot-com bubble in the late 1990s, the housing bubble in the mid-2000s, and has been vocal about other significant market disruptions. Grantham's methodology often involves examining historical market data, identifying patterns, and recognizing when asset prices deviate significantly from their historical norms. Grantham's framework for understanding bubbles relies on several key indicators. Number 1. Valuation metrics. Renowned investor Jeremy Grantham frequently cites valuation metrics such as cyclically adjusted price-to-earnings ratio as evidence that markets have entered bubble territory. The CAPE ratio compares current stock prices to the average earnings of a company over the past decade, providing a more comprehensive and long-term perspective on market valuations. When these valuation metrics reach historically elevated levels, Grantham contends that it is a clear indication that the market has become overheated and is poised for a significant correction. By drawing attention to these objective, data-driven measures, Grantham presents a compelling case that the current market environment has become detached from underlying fundamentals, signaling the potential for a major market downturn on the horizon. Number 2. Psychological factors. He emphasizes the crucial role that investor psychology plays in driving the formation and perpetuation of financial bubbles. During periods of widespread euphoria and irrational exuberance, investors can become swept up in the frenzy, leading to unsustainable and speculative increases in asset prices that eventually collapse. Grantham frequently cites the renowned economist John Maynard Keynes, who famously observed that the market can stay irrational longer than you can stay solvent. This insightful quote underscores the difficulty investors face in timing the bursting of a bubble, as the market's irrationality can persist for an extended period, posing significant risks to those who attempt to bet against the trend. Number 3. Historical parallels. Grantham, a renowned market strategist, often draws compelling parallels between the current market conditions and the characteristics of past financial bubbles. By meticulously examining the historical precedents of market exuberance and its excess, he aims to forecast with greater precision the timing and magnitude of potential market collapses that may lie ahead. This approach of juxtaposing the present against the lessons of the past allows Grantham to construct a compelling narrative that seeks to warn investors and prepare them for the possibility of impending market downturns. Through his rigorous analysis of historical patterns, Grantham endeavors to equip his audience with a deeper understanding of the cyclical nature of financial markets and the importance of anticipating and navigating periods of heightened volatility and risk. Grantham has repeatedly pointed out that the current market valuations are at extreme levels. For instance, the CAPE ratio for the S&P 500 has been significantly above its historical average for several years. High valuations suggest that future returns are likely to be lower and the risk of a market correction is elevated. Grantham argues that corporate profit margins are unsustainably high. Historically, profit margins tend to revert to the mean over time. However, in recent years, margins have remained elevated due to factors such as tax cuts, low interest rates, and cost-cutting measures. Grantham believes that these margins will eventually contract, leading to a decline in corporate earnings and, consequently, stock prices. High levels of corporate and government debt are another concern for Grantham. Low interest rates have encouraged borrowing, leading to an increase in leverage across the economy. This debt buildup makes the financial system more vulnerable to shocks, as highly leveraged entities may struggle to service their debt in the event of a downturn. Grantham has observed speculative behavior across various asset classes, including equities, real estate, and cryptocurrencies. He points to phenomena such as the rise of meme stocks, the surge in initial public offerings, and the speculative frenzy in digital assets as signs of an overheated market. Such speculative excesses are often precursors to market bubbles and subsequent collapses. Beyond financial market indicators, Grantham considers broader economic and environmental factors that could contribute to a collapse. Grantham is a vocal advocate for addressing climate change and has warned about its potential economic impacts. He believes that the failure to adequately address climate change could lead to severe economic disruptions. For example, extreme weather events, rising sea levels, and other climate-related phenomena could cause significant damage to infrastructure, disrupt supply chains, and result in substantial economic losses. Grantham is also concerned about the depletion of natural resources. He argues that the overconsumption of finite resources such as fossil fuels, minerals, and fresh water is unsustainable in the long run. As these resources become scarcer, the prices are likely to increase, leading to higher costs for businesses and consumers and potentially triggering economic instability. Grantham is particularly concerned about rising income inequality. He argues that extreme disparities in wealth and income can lead to social unrest and political instability. As the gap between the rich and the poor widens, the potential for social upheaval increases, which can have significant economic consequences. Grantham also points to political dysfunction as a risk factor. He argues that polarized politics and ineffective governance can hinder the ability to address critical issues, such as fiscal policy, infrastructure investment, and environmental protection. Political gridlock and policy uncertainty can undermine investor confidence and contribute to market instability. One of the most challenging aspects of predicting market collapses is timing. While Grantham is confident that a collapse is inevitable, he acknowledges that pinpointing the exact timing is difficult. Markets can remain irrational for extended periods, and predicting the precise moment when a bubble will burst is inherently challenging. Investors need to be cautious in the current environment. Grantham advises reducing exposure to overvalued assets and increasing allocations to more defensive investments, such as cash, bonds, and real assets. Diversification and risk management are crucial to weathering potential market turbulence. Policymakers should consider the risks posed by excessive valuations, high debt levels, and speculative behavior. Implementing measures to promote financial stability, such as prudent regulation and oversight of financial markets, can help mitigate the impact of a potential collapse. Additionally, addressing underlying economic and environmental issues such as income inequality and climate change is essential for long-term stability. A market collapse could have far-reaching consequences for society. It could lead to job losses, reduced economic growth, and increased social unrest. Addressing the root causes of economic instability, such as income inequality and resource depletion, is critical for building a more resilient and sustainable economy. This dire forecast is rooted in Grantham's meticulous analysis of historical market patterns, current valuation metrics, and a deep understanding of broader economic, environmental, and societal factors. While the precise timing of such a collapse remains uncertain, Grantham's warnings could serve as a clarion call for investors, policymakers, and a society as a whole to take heed and prepare for the potential challenges that lie ahead. Jeremy Grantham, the legendary investor, believes we are headed for a massive collapse. Scary stuff, right? But hey, it's important to understand different perspectives. Whether you agree or disagree, let me know your thoughts in the comments below. Don't forget to like, subscribe, and hit the bell notification for more financial breakdowns and market analysis.